Have you ever Googled your own name? Prepare for a shock because your personal info, including addresses and phone numbers, is all out there. It's all harvested by data brokers and sold legally. Aura is a personal digital security service that scans the internet for your sensitive information and provides a full suite of privacy-enhancing tools. For a limited time, Aura is offering listeners a 14-day free trial at aura.com/safety. That's AURA.com/safety to learn more and activate the 14-day trial period.
Shares for beginners.
Being short-sighted, it's very hard to avoid. It's very hard to avoid in other parts of life, but investing to create wealth is absolutely devastating. We've quoted earlier a couple of studies, but all your listeners out there, I know myself, when I initially started investing myself directly, I was myopic, maybe being younger and being a bit more bravo. It's definitely something you want to avoid. So myopia, next time you think about doing something, head over to Specsavers.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. How many of our investing mistakes come from emotions and psychological biases? Warren Buffett said that the biggest obstacles to investment returns are fees and emotions. My guest today is here to rifle through the dark passages of the soul and hopefully show us how to become better investors. Hello, Zaffar.
Hi Phil, great to be here.
Great to have you. I'm looking forward to going through all the psychological undergrowth today.
Looking forward to it.
Zaffar Subedar has over 15 years of experience in the financial services industry and academia. He's currently with eInvest, where he works with advisors and researchers. In his spare time, Zaffar enjoys furthering his knowledge of behavioural finance, which was your PhD subject area.
That's right, a very long time ago, but a subject area that I thoroughly enjoyed and I can continually enjoy to this day. And I think I'm very fortunate to observe a lot of behaviours that...
in real time.
Yeah, that literally came out of the lab, so to speak, and they're happening on a daily basis.
So is it like that? Is it something that you work on theoretically and you're actually seeing things playing out now that, as you say, were investigated in the lab?
Yeah, well, most definitely. If I take a step back, so when I was at uni and beginning the PhD... a very long time ago now, shows my age, but a lot of the studies initially started with university students by psychology professors. So they were natural experiments.
They were the guinea pigs.
Yeah, they were the guinea pigs, but effectively these professors, predominantly in the US, they examined how people made decisions under uncertainty, which is what we do when we're investing. We're investing where there's uncertain outcomes. And they eventually found that people weren't behaving in line with what traditional economic models were built on. So that created this whole field of behavioural finance that examined in particular how people made decisions, whereas traditional theory, which a lot of the financial and economic models are built on, they're very prescriptive. How people should be valuing assets, how people should make decisions based on this information set. So it was a really revolutionary field, and the field has spawned into marketing, it spawned into government policy, and a lot of your listeners, no doubt, probably read a lot themselves and are probably doing some nasty things, but hey, we're all investors, and that's the beauty of behavioural finance, that it applies to everyone, professionals and individuals.
They're kind of emotions. We're all emotional creatures, aren't we?
Yeah, no, we're definitely emotional creatures, but it's really how we make decisions and how we can better ourselves, which is an outcome of these emotions. These emotions trigger us, particularly in uncertain environments, probably to do things that aren't good for us from an investment standpoint.
So what's the definition of behavioural finance? What's the laboratory definition of behavioural finance?
Well, in short, the simple definition is it's a application of psychology to investment decision making. So very, very short, and that's really the short line definition.
So investing over the last 2 years has been extremely difficult. We've all been inundated with negative news, case numbers, worst case scenarios for outbreaks, lockdowns, and now war. How does this affect our ability to make optimal investment decisions?
Yeah, that's a great question, Phil, and what really makes investment decision-making difficult in these types of environment is the volume of information. and what type of information that comes to mind. So yes, you've got a lot of economic commentators, you've got a lot of reports if you're an investment decision maker to consider, you've got a lot of economic data, but amongst all that, you've obviously got the usual headlines, the usual fake news, clickbait type of headlines that grab a lot of attention, and that clouds our ability to make a decision. And when you're in this type of environment, instead of sitting back and making an investment decision over, medium or longer term horizon, we tend to use shortcuts. And it's these shortcuts that really cloud our decision making, and a lot of people may suffer with their wealth by making a decision that's not in their best interest. So it's really that clouding around the volume of information and how we use it.
That was interesting reading your article, actually, because I've only just recently learnt the word heuristic, what heuristic means. And it's a shortcut, isn't it? A shortcut in thinking.
That's right. They're just simple rules of thumbs to make decisions. And I guess an example of non-investment making heuristics is the old chocolate example. So think about if you've got chocolate that's right next to you on the desk, you'll grab it. Now, if it's in the kitchen, are you going to walk over there and get it? You're probably not as likely to do that. Now, you're thinking, well, how does this make any sense to investments? Well, it does. If you monitor your investments frequently, you're more likely to make a decision. And whether that decision is good or bad, most times it's usually bad. That shows us that constantly looking at something isn't good. So in real life, we know if you look at something, if you're trying to lose weight, you weigh yourself every day, you'll get frustrated, go off track early. It's the same thing with investment decision making. If you keep looking at something frequently, you will more likely make a poor decision. So these are sort of common things that happen in real life in other domains that can also happen in the investment world as well.
There's an article that we'll link to that listeners can read where you talk about the decisions that Australians were making in their superannuation funds during the COVID pandemic and how many negative impacts occurred with their investments by the decisions that they made due to fear. Tell us about that.
Yeah, there was a good study, Phil, I think, especially given what time period they looked at, which was during the first initial bout of COVID in early 2020. But really the main two studies that they found, which may be relevant to our topic, was that they found that the superannuation members, they switched between investment options. But what was important was with this switch, over 70% of people in this study had a negative outcome. So if we remember, the market tanked and then there was a recovery. So they switched as the market tanked and kept tanking, and then obviously there was that recovery. By taking that course of action, by monitoring their investments very frequently, they did something which was quite adverse to them.
So is this in your superannuation options? You get like conservative or aggressive and various ranges along that spectrum. Are these people moving from aggressive to conservative? Is that the kind of actions that they were taking?
Yeah, so they could have moved from those type of options, whether it could be diversified funds, or they may have gone from equities back into cash, change their investment options like that. So that was along those lines there where they looked at transaction data.
And that's what people do, is as soon as there's any fear, they start selling and trying to get into some form of safety. But this is not necessarily going to be great for their investment decisions in the long term, is it?
No, exactly. And there was earlier studies back in the US, I think just before the tech wreck, the late 90s. So if we all remember back many years ago when retail broking started, so when retail investors could go online and buy and sell quite easily, they found in the US late 90s that there was a study by an academic there, and he found that the retail investors tended to sell their better performing stocks in their portfolio and they would hold on to their losers. And they found over a 12-month period, the ones they sold early went on average to return another sort of 3 to 4%.
Yeah.
And, again, that's this whole basis of, let's look at this, we've made a profit, let's trade early, get that gain, but then hang on, when the opposite happens, we'll hold it. So this whole use of information, looking at something too frequently, particularly if you're trying to create some medium to long-term wealth, which is very hard to be immune from, particularly as a retail or self-directed investor.
I think there's also another study that shows that the best performing portfolios at that time were people who'd actually passed away. no one was doing anything with these portfolios, and they were actually performing better than most other more active portfolios.
Yeah, that's right. There's, again, numerous studies that have shown some buy and hold or strategies with less turnover tend to do better over time. And probably, again, if you think about it, you like an investment, if it's an equity investment, you do need time for that thesis to hold. And those portfolios definitely that have lower turnover will show those factors.
Okay, so let's go through the list of self-sabotaging behaviours. And there's a couple of biases that you refer to, and one is representativeness. Tell us about representativeness.
Yeah, no, and these self-sabotaging behaviours, they are heuristics. So essentially these are also heuristics which we discussed earlier.
Shortcuts, heuristic shortcuts, yeah.
That's right. So representativeness is the tendency for investors to make decisions based on stereotypes where perhaps none exist. So it really is looking at information and making decisions assuming that what's happened in the past, whether this trend, whether it's a short-term trend, persists for a longer period of time. And what we do find over time is that using this type of heuristic, there's actually no trend, and they are basically chances or random chances of fact that lead to poor decisions. So if I give you an example, let's look at earnings of a recently listed company. So if you think about IPOs or companies with limited public history, they might show histories of high earnings growth, or if it's an IPO, they might have forecasts for definitely high earnings growth. Now, as an investor, if we think this trend will continue, even though there might only be a couple of quarters of publicly available information, then we could be hit for a rude surprise when, in fact, the company's earnings don't grow to anywhere near that level, because we would have gone in and paid a high value for that particular stock and the earnings don't eventuate and we get hit. That's probably a common one that's out there as well.
And another bias is the availability bias. Tell us about that one.
Yeah, no, this is a very interesting one. And again, these are all based on how we make decisions based on information that we have. But essentially, the availability bias occurs when we make a decision based on recent experience or information that is readily available to you. And that's the key, what's readily available to you. So, if you consider you watch the news, 6 o'clock news or whatever time you watch the news, if a particular stock or particular market gets quoted in the news, then that's what you will base your decision on. So, the ASX was down today, therefore I'm not going to invest tomorrow, or the ASX has been down all week, I'm not going to invest now because I'm worried about the outlook. So where you get your information from and how frequently you source that information from does affect your decision. Conversely, other studies have found if we use availability bias, particularly at a high level, such as looking at market data, as I just gave an example of, we tend to overreact more because we think and we overestimate that these bad events will continually occur, and either we don't invest or we make a decision of let's cut out and get out of here. So it's a very crucial bias that we need to keep an eye on of where we source our information from and how we use that information to make a decision.
In preparing this interview, I recently interviewed a psychologist about the emotions that sabotage good investment decisions. And this was his list: greed, fear, euphoria, despair, overconfidence, and strangely enough, regret. Do you have any comments on that list?
Yeah, look, I think that's a great list. And if you read the literature, not just the academic one, but a lot of the investing literature that's out there, these emotions that the psychologist mentioned, they hit all the relevant characteristics. But the only one I would probably add to that list is really myopia, and that's that being short-sightedness. That's really detrimental to wealth creation. Again, if you are so short-sighted and you try and identify patterns based on information that's readily available, and particularly if it's not thorough or accurate information, then this is the most critical behavior that you would have to your long-term wealth creation. Being short-sighted, it's very hard to avoid. It's very hard to avoid in other parts of life, but investing to create wealth is absolutely devastating. Like we've quoted earlier a couple of studies, but all your listeners out there, I know myself, I When I initially started investing myself directly, I was myopic, maybe being younger and being a bit more bravo. It's definitely something you want to avoid. So myopia, just next time you think about doing something, head over to Specsavers.
We are pattern recognition creatures, aren't we? I mean, we're actually built to recognise patterns, but sometimes we can just make up patterns out of thin air almost, can't we?
Well, we look for patterns where none exist.
None might exist, yeah.
And that's the crucial piece there, that when you look for these patterns, do they happen over time? And when these patterns occurred, what are the drivers of these patterns? So if you're looking at a company's price chart, well, what's been driving this price movement, either up or down? What's happening on the fundamentals? What's happening to that investment relative to its peers? You need to consider more than that, just one piece of information. You need to look at the information in totality.
Did you know that personal information, like addresses and phone numbers, is collected and sold by data brokers across the internet? Fortunately, Aura steps in, scanning the web, sending you alerts, and requesting the removal of your info when found. Get a 14-day free trial of Aura's full toolkit, including ID theft protection, parental controls, and more at aura.com/safety. That's AURA.com/safety.
Another thing that I've been really interested in thinking about lately is about the idea of shame. I mean, it's not just regret. You can make an investment decision, it goes bad, and you feel shame. You feel like a loser. And that's a really powerful emotion. Is that something that you've seen, or have academics studied that?
Yeah, so there's a couple of ways you can look at shame. And from the behavioural finance literature, the item I think that really summarises shame is loss aversion. So loss aversion is probably something that really relates to shame. And the piece that loss aversion really summarises is that it describes the pain of losing on an investment. And what the psychologists and what the behavioural finance academics have found is that the pain of losing is 2.5 times more than an equivalent gain.
How do they measure that? I mean, I've heard that statistic. How do they measure that?
Oh, they've measured that through a number of studies around uncertainty.
Questionnaires.
Well, experiments. They've been the predominant way of doing that. And this 2.5 times, it's not just with university students, it's with individual investors. I think I did a study a long time ago with finance professionals. This was just after the GFC, and I think they viewed the loss about 40 times more than an equivalent gain. So if you think about it,
they had professional skin in the game, didn't they?
That's right. And I think the way to interpret it is like, if I've gained 10%, I feel good. But if I lose 10%, I feel very, very bad. That's the sort of qualitative summary of it. But I think the other point around loss aversion and shame, there's a couple of points. The reason why we hold on to our investments, so go back to that loss aversion, you've lost 5-10%, but it feels 2.5 times more than that actual loss. The piece is we now feel that, hang on, I like this investment. I've liked it for a number of reasons, but I think it's going to rebound. So this is where we are letting the losers ride, because we are in the hope that this investment will rebound. The second point is it's also that attachment. You've done so much work on this investment. You spent a lot of hours sourcing information, making the decision. And probably thirdly, you've gone out and told other people, so you've got that shame of, hang on, I'm going to end up here with egg on my face because, I've spent so much time looking at this investment and now it's underwater by 10-15%. I need to hold on to it because it's going to come good. So this is a challenge. So this shame or this loss aversion, that is something that explains why we ride losers in the hope of our investments to recover. But if we go back to those earlier studies, we tend to do the opposite and cap out our winners and ride those losers. And also, the other thing I should say is someone will say, what about tax and those sort of things? Well, yes, there could be some tax advantages there with riding some of the losers. But, that's an area where I recommend you talk to your tax agent on.
That's right. It's not about tax. It's about making money in the end, isn't it?
Well, that's the old saying, isn't it? If you're paying tax, you're making money.
What about searching for gurus? I think there's a lot of people who want a guru as well.
Yeah, and there was a very, very peculiar study. It was actually done by some New Zealand academics, probably mid-2000s, and they call this the socialization effect. So if you think about it, you're going into a new environment, think about you're going into a new workplace, or you're going into a new school if you're a child, or you're going into some sort of professional environment. When you walk into that environment, you, from a previous experience, what your average was, are these people really good to work with? Yeah, they're pretty good. They're average compared to what I've experienced in the past. So all of a sudden, if you were at a previous workplace and your average might have been 7 for your previous employees in terms of how to work with and all that sort of jazz, now you go to a new workplace and all of a sudden it's a new environment and that average might be 6 or might be 5 or whatever it is. It's declining, or it could go the other way. So by going into a new environment, you start to change your mean. Now, what does that mean for investing? Back to your point about gurus. You will start sourcing people at the barbecue. You will start following other investment commentators that are out there, and that now frames your environment to make a decision. So if they're a good stock picker or they're an average stock picker, do you measure that? And if they're not a good stock picker, if you haven't objectively measured that, guess what? Your new average is going to be a lot lower than perhaps what it was before. So it's very, very crucial what environment you're in and where you source information from to help you with, again, your long-term wealth.
And it's also worth knowing that gurus are fallible as well. They maybe don't even have any better idea of investing than you do.
Well, that's right. And we've seen now the 10-second investment updates you get on TikTok. Mm-hmm. So the world is getting a lot more complex than what it was probably just 2 years ago.
Yeah, I know. I wouldn't have made any money without those. Joke, listeners, yeah. So the gurus that are setting themselves up on YouTube and TikTok and all over the social media now, they're not going through the rigorous process that many professionals in the financial industry have to do to justify their purchases and buying and selling decisions. What's something to watch out for, and how can people think about these supposed gurus?
So I think one way to look at gurus and anyone that you use to influence your decision-making process is to consider their track record. So it's not just buy a particular investment. It's like, well, overall, how is their portfolio? Do they even have a portfolio? Do they show their holdings? Do they show what their investment mandate is? So, for example, some people might be high risk versus someone that's low risk. So how do you compare the pair, so to speak? So that's why probably have a look at the institutional investors or the professional investors. So if you look at particularly active ETF providers, they've got all their holdings on their website.
They have a process, and they tell you exactly what they're doing, how they're investing, and their reasons for investing as well.
That's right. They're very transparent. They've got a monthly update where they talk about what they've done with the portfolio, what the outlook is, what were the major drivers and contributors to the performance over the last month. So you've got a transparent record there. And obviously you can go through and see the investment processes as well. And that's a bare minimum amount of verification you should be using to look at investment recommendations or obviously the performance of that type of investment you're considering. So there's a difference there between gurus and professionals. And again, looking at track records and making sure the results are actually valid is important.
Yep. For me as well, it's the idea that you've got to understand that there is a process. You don't get tickers served to you on a plate. A lot of people come in and they want to be told what to buy and sell. And that's no way of achieving commitment to a company or a portfolio that you're putting together.
Yeah, that's right. And usually someone that's doing a recommendation has got a different incentivization, whereas an active manager or a professional manager, they are managing to a mandate, and you need to consider if that investment will have a role in your portfolio.
Okay, so we've heard about these biases. What are the shortcuts that we can take to become aware of them and be able to basically put these biases back in the place where they should be, which is not affecting our investing decisions?
Yeah, and this is it's a great question. I struggled with myself for a long time, and look, I studied this for a period of time. It's very difficult to do, first of all, and if you commit to this journey, there's no doubt you will be a better investor. And I think the key thing is if you can identify some of these biases, you won't feel as ruffled, definitely as much during some of these panic moments or the moments of volatility that we've been going through. So it's definitely an exercise worth doing. I guess one of them, and we just discussed it, was really keeping a record of your investment decisions, and particularly where you were really confident with a decision. How did that go? So track that. That's probably the first key point. So where you were feeling overconfident, very high conviction call, how did that investment decision go? And also, what sources of information did you use? You must be consistent. So if you're looking at Australian shares or you're looking at global shares, what sources of information? Who else were you listening to? Ensure that you are consistent, because whenever you're buying or selling, it becomes a relative decision, and you want to ensure that you use the same sources of information to come to that conclusion. Thirdly, obviously, don't monitor results too frequently. Whenever you purchase something, particularly if it's a risky investment, there will be volatility. Use that time, use that volatility to ride out your decision. Give it time. So that's also important. Again, don't be myopic. Let your investment thesis mature. Another one, and it's probably a little bit more qualitative, is an investment out of character? So if you've historically been someone that's invested in listed investments and now you're considering something that's not as liquid, such as venture capital or private equity, private debt, why are you going down that path? And what prism are you going to look through to evaluate this investment? So that's something you should look at, particularly, I think, with the new sorts of investment offerings that are out there, new asset classes, be it cryptocurrency or more sophisticated type investments. I also think you need to consider the multidimensional nature of risk. So it's not a particular risk to an investment, but what about things such as credit, particular relationships? So we know what's happening if you've invested with anything linked to Russia. Think about those things when you're investing in something peculiar or something that's higher risk. Is there one or two other qualitative risks that may affect that type of business that you can't see in the financial statements? So that's something probably you have to keep an eye on. And finally, think about your information sources. Is using the street research, or using that traditional broker research you may be getting off your retail trading site, giving you a competitive advantage? If you're looking at large cap stocks, it's probably difficult to get that competitive advantage by just using broker research. You need to consider
they're all doing it, aren't they? There's so many people researching.
You probably need to do a bit more work around those aspects there. And I think finally, the other piece is just be careful with how you socialize your investment decisions. So whether you're at a barbecue, whether you're at a pub or any sort of social settings, it's just human nature to hear the good stories, but it's that one bad story that may give you second thoughts when you're looking at a particular decision. So, always consider the old anecdotes that are out there with a grain of salt, because as we know with human networks, we do like to show ourselves in the best light.
It sounds to me it's all about having a process, isn't it?
That's right, Phil. And look at eInvest. We've got professional teams across Aussie equities and fixed income. And those specialists, yes, they invest according to their mandates, but they've got deep teams of professionals that only focus on investment decisions day in and day out. And they challenge each other. They challenge each other where they get information from, are they consistent with their calls, and how they measure up on a frequent basis. And also importantly, in these sort of environments, where are the opportunities? So, for a professional, it's just as important to look at your information sources, but you've got the extra layer of having transparency with your investors. And that's why it's fantastic at eInvest. We've got some great teams that look right under the hood for opportunities, whether it's in Australia or in fixed income globally as well. And they've been quite robust in these times of volatility.
If people want to find out more information, they can go to the website, which is einvest.com.au/BF for Behavioural Finance, of course. And you can ask questions, get some more information and links to Zaff's articles about this as well. Zaffar Subedar, thank you very much for joining me today.
Thanks, Phil. It's great to be here.
If you found this podcast helpful, please tell a friend, especially if it's someone who needs to start thinking about investing for their future. You'll be helping them and helping me to keep this show on the road.
Shares for Beginners is for information and educational purposes only. It isn't financial advice, and you shouldn't buy or sell any investments based on what you've heard here. Any opinion or commentary is the view of the speaker only, not Shares for Beginners. This podcast doesn't replace professional advice regarding your personal financial needs, circumstances, or current situation.
And thank you for listening to my podcast.
Have you ever Googled your own name? Prepare for a shock because your personal info, including addresses and phone numbers, is all out there. It's all harvested by data brokers and sold legally. Aura is a personal digital security service that scans the internet for your sensitive information and provides a full suite of privacy-enhancing tools. For a limited time, Aura is offering listeners a 14-day free trial at aura.com/safety. That's AURA.com/safety to learn more and activate the 14-day trial period.